Did you guys get your free money from Moomoo yet? If not, use my link down below, deposit at least $100, and just like that, you get up to 5 free shares of stock, each up to $2,500, and if you deposit at least $2,000, you also get 1 free share of Twitter, guaranteed. So use that link down below. And now, let's get into the video, guys. Cheers. Today was an absolute bloodbath. We had the S&P 500 down over 4% at the close. The Dow Jones went down 3.6%. The Russell also went down, funny enough, 3.6%, as the NASDAQ 100 closed down over 5%, guys, which is just unbelievable. We had the VIX up about 20%, closing over 30, and we had gold and silver. I mean, they didn't do that bad, but gold did go down 0.2%. Silver went down 1.5%. And the crazy thing is, guys, today was the biggest drop since June 2020 for the Dow Jones Industrial Average. Look at that, over 1,100 point decline today for the Dow, and it's pretty much right at the lows from a couple of trading days ago. The lows back then were 31.2, and we're now at 31.5 roughly, so we're pretty much 300 points off of the recent lows, and it's not looking good now for the Dow. The Dow is now almost down probably 15%. Yeah, almost 15% from all-time highs. So when if the Dow gets into a bear market, that's when you know it's getting real, guys, because we already have the Russell. I mean, the Russell and the NASDAQ, they've already been in a bear market. The S&P's in a bear market. The only one left is the Dow, and it's almost there. It's almost there. So let's see how far down SPY and Triple Q are now with today's bloodbath. Let's see how far they're down from all-time highs. So SPY's not in a bear market. What the heck? It's not. I guess it's not. It's down only, I mean, that's a lot. 18.6%. It's a good chunk. Let's just put it that way. So it's almost in a bear market. But Triple Q, trust me on this, guys, it is deep in a bear market. No doubt about it. So the reason why the big sell-off kind of kicked off today, and mind you, now Triple Q is down 30% pretty much from that all-time high. So the reason why we got this sell-off is really from the big box retailers, Walmart, what's the other one? Target. You guys saw what happened at Target. So we are really seeing inflation not letting up. The inflation pressures on these companies, it's unreal right now, and they're suffering. I mean, it's a reality that we're all experiencing right now. I mean, gas in my area, not to get on a whole side tangent here and talk about gas prices, but it's only going up higher. I remember 3-4 weeks ago, it actually went down under $4 a gallon for regular here. It was at like $3.85, $3.90, and let me tell you, that did not last, because today per gallon, right where I'm at, guys, here in New Jersey, $4.65. So it's up a ridiculous amount, and mind you, that is the highest that it's been, at least that I've seen here in my area. So yeah, big move up for gas. That's affecting companies, all across the board here, and it's not looking like it's letting up. I mean, CPI data was 8.5, or rather 8.3% annualized for April. It was 8.5% in March, so it's not letting up anytime soon, and who knows? It might get worse. We have to just be patient. And the truth is, in times like these, guys, not to go on a rant on long-term investing, but this is where truly dollar cost averaging wins in the long term. This is where you really build strong positions, whether it be individual stocks, index funds, whatever, ETFs. This is where dollar cost averaging really starts working long term, because each day, each week, I mean, geez, guys, these markets, we have been hitting new lows pretty much week after week after week. And if you're dollar cost averaging every week, which I am, I know a lot of you guys are, every 2 weeks, from your job, or with your traditional brokerage, or taxable, whatever you guys are doing, you're probably doing the same thing. Now is really, in my opinion, and you guys could probably agree with me, I'm not a financial advisor, but come on, you guys know what I'm talking about. Now is the best time for averaging in, especially if you have a long-term perspective. And I always say, if you have a 1-year outlook, even a 2-3 year outlook, I wouldn't invest. If you want to buy property or you need this money for something important coming up, I would just keep it in cash, to be honest, guys. But for the long term, we're talking 10, 15, 20 plus years. These buys that we're making today, and if it goes lower, those buys that we make at the lower prices, those are the ones that really count long term, right? That's where the wealth is made, long term. Again, for ETFs, individual stocks, and I'm not talking meme stocks, penny stocks. I'm talking blue chip, strong, profitable companies. I'm talking index funds, ETFs. These buys we make today are the buys that are going to benefit us in the future, heavily, right? Let's just put it that way. So right now, basically what I'm noticing in the short term on Triple Q is it's in free fall mode. We're clearly under the lows from earlier in May. Those were at 296. I mentioned those in my previous video. We closed at 291, and now after the bell, it's crazy. Triple Q is actually down another $1. Look at this. It is down under 290 right now, and we close a little bit above 291. So this is falling even more after the bell. And I said this earlier, and I'm saying it again. I think this could easily take the lows out. 284 was that low from about 6 days ago. And SPY, let's pull that up. SPY is also in the same predicament. It took the lows out from earlier in May. You guys can see here those lows were at about 395. We closed well under those. Excuse me, guys. Right around 390, 391. And we're only $5-6 off of those 385 lows from about 6 days ago. And if we fell, let's say another, 1%, 1.5% tomorrow, which could easily happen, we're right at the lows, just like that, guys. So the markets, they're getting worse. It looks like that rally that we saw ended up being a bull trap, 100%. And I personally, you guys on my Patreon know you get all my buys, sells, call-outs, morning videos, all that good stuff, more access to me throughout the day. You guys know that I ended up selling out of my VOO, my short-term VOO position yesterday. Made some money on that. And I also sold out of my Adobe short-term position. And that's the type of market that we're in. We got to be nimble. Just because we have gains today doesn't mean we'll have them tomorrow. They can easily be wiped out, and that's why I locked in profits. And let's say I held Adobe, guys, I would probably be right back at break even right now. Pretty much. I bought these shares at $393. I sold them at $413. Now they're at $397 again. And for VOO, I bought them at $368, sold them at, I think, roughly $374, and now VOO is at $360. So if I held, I would actually be down $8 per share on my position. So sometimes profit, if you see it, if you're trading, and we're in these volatile markets, sometimes it's smart to just lock in profits and wait for the next day. That's kind of what I did, and clearly it ended up paying off. So what do you guys think? I mean, are you buying now? Are you selling? For the short term, for me, again, I'm being very nimble, but long-term wise, don't get it twisted, guys. I am buying my companies that I love. I'm dollar cost averaging. What are you guys doing? Are you guys doing the same? Let me know in the comments. Smash that like button and make sure to subscribe if you haven't done so already. We are almost at the milestone, guys. The milestone being 25,000 subscribers. We are 30 subscribers away. So if you haven't done so already, smash that subscribe button and let's talk about some stocks. We have some stocks to talk about in this video, some of which are crashing, some of which aren't crashing that badly. So number one is Cisco, which, guys, it is crashing. Cisco is crashing. It closed at $48. It already went down 4.4% on the day. And now after the bell, it is down to $42, and it actually got down to $39. So at one point, Cisco was down about 20% after the bell. Yet again, another stock, big company, going down 20+% after an earnings. I mean, this is just crazy, right? So Cisco ended up doing 87 cents versus 86 cents estimated on EPS, so they beat that by a penny. And they did revenue, which didn't beat, $12.8 billion versus $13.34 billion estimated. So they missed on revenue, but again, they beat EPS by a penny. penny, and they see full year 22 revenue up 2 to 3% year over year. Not that great, but not horrible, I guess, either. I mean, 2 to 3%. It's 2 to 3%. I mean, I don't know what else you guys want me to say about that. And they see full year 22 adjusted EPS between $3.29 and $3.37. So this stock, again, is completely collapsing, probably on that soft revenue number. I mean, they missed by a long shot. So that's a big reason, in my opinion. Also, let's see here. Anything about guidance? Anything more about guidance? It looks like they returned $1.8 billion to stockholders through share buybacks and dividends in Q3. So honestly, with the stock getting destroyed right now, Cisco might be buying back more shares, or they might increase their buyback program. I mean, they're not necessarily doing that. I'm speculating, but hey, why not? Why not do that? Even though it looks like they did cut their 22 outlook. If that stock price comes down a lot, they pay a dividend, but you can also reward shareholders by buying back stock. We've talked about this many times on the channel. That's a way that Google does it. Apple, a lot of the big tech names buy back a crazy amount of stock. They might not pay dividends. Well, I guess Google doesn't pay. Apple pays a dividend. I think Microsoft pays a little dividend as well. But if a company doesn't pay a dividend, it doesn't necessarily mean they're not returning money to the shareholders in other ways. They could buy back shares. In other words, taking shares off of the market, meaning your shares that you already own, they become more valuable, right? That's just another way that management can just reward the shareholders, right? So Cisco's free falling. Let's take a look at the yearly chart. Oh, that looks horrible. Let's pop up the 3-year chart. Okay, that doesn't look as bad. So at this point, Cisco's right by the 180 SMA on this 3-year chart, which is right around literally where it is now, 48, 50, 51 bucks a share. So let's see if this is where we hold. Maybe we get buyers coming in here. I'm not banking on that, but let's see how it happens or plays out, unfolds, over the next couple of days and honestly probably the next couple of weeks. This might not bottom tomorrow. In fact, it probably won't bottom tomorrow. I'm not calling bottoms, but you guys got to realize when stocks collapse like that, it might continue on bleeding. You never know. I mean, look at Facebook. It collapsed after earnings when we saw that 20% drop, and it just kept on bleeding. Trust me, I know, because I've been buying the dip, right? And I'm planning on buying more Facebook. We might as well transition to that one. I'm planning on buying more of it tomorrow. If this red market continues, Facebook gets under 180 bucks a share, or 190 bucks rather. And mind you, today Facebook went down 5%. If it gets under 190, I will be buying more Facebook because this is a company that I believe in 5-10 years from now. I think they're still going to be around, and they just make so much money. The valuation for me is so cheap right now. It's a buy for me, and that doesn't mean it should be a buy for you. I'm just telling you guys what I'm thinking. But again, going back and tying it into Cisco, remember when Facebook reported two quarters ago? It went down from 330 to about 240. And some people were probably like, oh, this is the bottom. That's it. It's going to bounce tomorrow. And look at where it is now. From 250, now it's at 190. It kept on slowly bleeding, which for me, I don't care because I'm looking to buy shares, dollar cost average on the way down. But if you think Cisco's bottoming today, and you're like, oh, I'm going to buy it, it could easily bleed from where it is now, 42, into the mid-30s, low 30s over the next couple of weeks. Don't think that's not possible because let me tell you, it is, especially in the markets that we are in right now. So let's talk about the next one, which is ZIM. Let me get some... this is not water. What is this? A body armor, guys. Give me a second. Let's pull it up. Let's see what's going on with ZIM. This one went down 5.7% on the day, and they actually beat on EPS and revenue. Very solid beat, guys. EPS came in at $14.19 for ZIM versus the $12.53 estimate. So they beat EPS by over $1.50 a share, which is great. And they also beat revenue, $3.72 billion versus $3.47 billion estimated. So double beat for ZIM. And it looks like they're paying a $2.85 dividend on the 27th, which is on Is that next week? I don't think that's next week. It's probably the week after. Either way, whatever week it is, whatever day it is, they're paying a $2.85 dividend, and it looks like they paid. Did they pay a $17 dividend recently, guys? It looks like they did, but that might have been a one-off dividend. It might have been, because before that they paid $2.50. Before that they paid about $2. So it looks like they went $2, $2.50, and this is per quarter, by the way. Then 17, and now $2.85. So their dividends going up pretty massively. And last I checked, their yield is very high, guys. Very, very high. ZIM's yield right now, dividend yield, is 29%, which is very high. And for me, I've said this before, even though the chart looks pretty good, it might continue going up, guys. Who knows? But for me, this is like playing a game of musical chairs, right? The dividend yield is 30%. This company's doing very well in the short term. I don't think this is going to last long term. And, you know, when it stops, this could easily collapse. It could easily collapse. And I don't want to be in it for that reason alone. But who knows? Maybe I'll trade it. Heck, maybe you guys will trade it. I'm not telling you to trade it. I'm not telling you to buy it. I'm just keeping it real. You know, for me, this is a little bit too risky. Even though the chart looks good, we might break out. Heck, we might take the highs out. Jeffries is saying that this is a buy. You know, the stock's a buy. And their price target, although they lowered it, is still $100, guys. $100 a share, which the high is 91, and we're currently at 61. So the stock is down a lot, 32% recently. But either way, even though I'm not the biggest fan of the stock, I'm going to put an alert at $65 a share. Mark is at or above, and we'll see what it does. You know, if it starts breaking out 65, 68 plus, you know, this could be a breakout play. And again, I'll trade it. I'm not investing long term in this company. No way, especially with a lot of stocks now in bear markets, and I much rather own some other stocks, a lot of other stocks, for the long term than ZIM. Call me crazy though, guys. Call me crazy. Another one that I'm looking at is Lowe's, which, if you guys saw, they reported earnings this morning. Lowe's ended up going down over 5% on the day. And let's pull up some metrics on Lowe's. Give me a second here, guys. Let me pull it up on my Yahoo Finance app. Let's see here. So with today's drop, guys, again, down over 5.8% or 5.2% rather for the day, we have Lowe's at a $121 billion market cap. The PE ratio now for the trailing 12 months is right around 15. So the PE is getting to an interesting spot. I might have to do more digging on Lowe's here. And we have the dividend yield at 1.65%. Pretty solid. I mean, it's not the best dividend yield, but it's a decent dividend yield. Again, about 1.65%. And let's pull up and see what else we got here. So they ended up doing $3.51 EPS versus $3.23 estimated, and they did revenue of $23.7 billion versus $23.76 billion. So they did beat nicely on EPS, and revenue missed a little bit, but really it's not the end of the world. And we kind of expected these earnings, the earnings, because we saw Home Depot's earnings were pretty decent, right? Pretty solid. So Lowe's, it's not a huge surprise that they beat EPS, and the metrics weren't that bad. So we saw those numbers from Lowe's. They saw Q1 U.S. same-store sales down 3.8%, and it looks like that was versus the down 4.2 estimate, and Q1 same-store sales in general, not U.S., but same-store sales in general, were down 4% versus the down 2.5%. So, okay, I guess that was worse than the estimate. But overall, Lowe's, it's not falling nearly as bad as some other stocks today, like, again, Target. Walmart's down a lot lately. Costco's getting beaten to death today, down 12%, which, honestly, guys, bring it on. If I had to pick a company right now out of Costco, Target, Walmart, Home Depot, Lowe's, if I had to pick one of these companies, I would probably go with Costco. Let me see what Costco's P right now is. It would be Costco, Lowe's, or Home Depot. I mean, that's pretty much half of the selection. But I would probably go with Costco, to be honest. Let me see here their P ratio, especially if it came under 400, guys. Their P is it's still high, 34. That's pretty high. I'd want that under 20, which that there's a long way to go. So I don't know. Maybe I'd go with Lowe's for now. But if Costco's P came under a 25.20, probably 20. I'd be going Costco all day, which means, it has a long way to go down based on the P. I mean, if this came under 300, maybe it'd be at a P that I'd like, in terms of a P basis. But obviously, there's more to valuation than just that. But yeah, what do you guys think? Costco or Lowe's or Home Depot, Walmart, Target? Which one are you picking? Let me know in the comments. That's a pretty good question. Again, I'd probably go Lowe's right now, but if they were all the same valuation or valuation didn't matter, I'd probably go Costco. So I guess that's a good spot to wrap the video up, guys. What a freaking bloodbath today. It was just one of those days, and like I say all the time, if you're in this for the long term, sometimes the best thing to do on days like this is to just buy more, shut your laptop, your computer, your phone, don't look at it, and just walk away. If you're a long-term investor, that's the best thing you can do on days like this. And honestly, not even looking at it is even better. Just having your buys just come in, recurring, whatever, every week, 2 weeks, 3 weeks, month, whatever, and that's it. So if you all found value, hit that like button, subscribe, drop me a comment, get your free money from Moomoo, up to 5 free shares of stock, each up to $2,500. All you guys got to do is deposit at least $100, and if you deposit at least $2,000, you get a free share of Twitter, guaranteed, on top of the other 5 stocks. And make sure to join my Patreon and get your 5 stocks from Webull. So there's literally a lot of free money waiting for you guys down there. Again, join my Patreon as well if you want to. I'll catch you all in the next video. Thanks for watching as always. Peace out, guys.